Modeling and valuation. Congratulations. You're now on the green stage or the fifth stage. You're in year 7 to 8. You're going to go public very soon, okay? And we're going to deal with Goldman Sachs and maybe Morgan Stanley. It's going to be a lot of fun. But before we do that, um, you're going to play the role of the financial analyst, okay? So, how do Wall Street analysts make financial models and how do they value companies? So, you're not going to be a student anymore today. That's right. You're a financial analyst. You work on Wall Street. Okay, so you're going to learn exactly how Wall Street analysts work. You're going to learn what their secrets are. You're going to learn how they do due diligence, how they model companies. And a good analyst doesn't need others to form their opinions. And we talked about that before. I want you to be independent. Okay, I want you to do your own due diligence, your own research. And when analyzing companies, again, the last thing you should do, and I mentioned this before, is speak to management. And the reason is because those are the best salespeople in the world. There's a reason they're C-level executives and they're earning the big bucks. So be careful when trusting them, and just be very skeptical until all of your research is complete. And so how do you do it? Well, you start off going to sec.gov, and I'll show you all this in a minute, okay? And at sec.gov, you're going to look for something called the 10K. And it's kind of stupid. I don't know why the SEC makes you call it the 10K, but the 10K is basically the annual report or a 200-page document that has to be filed every year by companies that are publicly traded. And it's an awesome document because all the risks that company has by law has to be mentioned in that report. It is amazing, okay? There's background of the management team written up there in the 10K as well in the annual report. And of course, all the financials and what the company does as well. It's the best primer when you're coming up to speed on any company. Okay, so don't rely on Wall Street. Do your own research. Go to sec.gov. Understand what the risks are too. Understand the market, of course. So in this session, we're going to learn how financial analysts on Wall Street model companies, how they analyze sectors, how they assess management, how they get access to information. So let's do this. This is going to be a lot of fun. So again, there's no theory in this course for the most part. Okay, I'm going to kind of give you reality, how it's really done, as I've done this for many years. Okay, so let's kick it off with what is investor relations. Well, every big company has an IR team or investor relations team. And their job is to help you, the investor, understand the company that you're investing in. And so Microsoft, for example, has an amazing investor relations department. And you can call them up and talk to them, and anybody can, not just the big mutual funds or the big hedge funds. Anybody can. You just have to ask. Remember, Steve Jobs asked. But I don't want you to do that yet. I want you to do all your research first. And at the end of your research process, then pick up the phone if you're still confused and call investor relations. It's their job to help you, okay? They'd be happy to take your call. And that goes for all companies, okay? But smaller companies that are publicly traded might outsource their investor relations. And just go to their websites, man. You can figure it out. You can get the investor relations phone number easily there. Okay, so when you're building a model, what are the sources? Okay, so remember you've got the exact same access to information as these Wall Street firms have. And you're probably going to be better at doing it than they are because you're not biased. Okay. The first source is going to be sec.gov. We've talked about this before, but I want to go into a little bit more detail now on this one. Okay. The second source is the investor relations website. So modeling and valuation is very easy to do. It's a lot of fun, and it's a lot easier for publicly traded companies than it is for private companies. Remember when we modeled that private company earlier on in this course, it was difficult because we didn't know where to get access to the data. And so we basically just got the total addressable market, made a bunch of assumptions, and assumed what market share the company would get longer term. And that was revenue. And then we just kind of made assumptions and figured out expenses. Okay. Publicly traded companies are they're a joke. They're so easy to model. I'm going to show you how. Okay. So we're going to use Microsoft, ticker MSFT, and we're going to model Microsoft from scratch. I'm going to show you how to do this, and you can apply this to any company. It doesn't have to be a tech company. It can be any firm that's publicly traded. Okay, let's do this. So the first source is the investor relations website, okay, IR website. So open up your browser, search Google for Microsoft Internet Investor Relations, okay? And you can see on this website, you've got all this cool stuff. You've got events, meaning webcasts or web videos. I used to go up to Redmond, which is in the state of Washington, where Microsoft's headquarters are. I used to go up every summer. And I was an analyst at a couple of different funds. And I would go and, we would watch Steve Ballmer and Bill Gates present on their thoughts of the next year, what their future product roadmap looks like. And I got to meet Bill Gates. It was incredible. I was in heaven. I was in heaven. And actually, I'm going to tell you just a quick little story here. Now, you have to be aggressive. There was a luncheon at one event in Microsoft headquarters in 2003, and 500 people were there sitting down for lunch. And at Bill Gates' table, and each table had about 10 people, there was assigned seating. So, of course, on his left and on his right were the biggest shareholders in Microsoft, right? The Fidelity portfolio manager and the Capital portfolio manager. And I thought, you know what, man, I'm never going to get a chance like this again. And so I pulled up a chair in between the Fidelity portfolio manager and Bill Gates. And I got to sit next to Bill Gates and ask him a ton of questions. And I was in heaven. I mean, it was incredible. And he was very polite. He was very nice as well. Because I think the nature of my questions was a little bit less sophisticated than other investors. But he was very nice about it. But you got to take these chances in life. Anyway, sorry to digress. It was kind of a cool thing for me anyway. So on the investor relations website, you can get access to these events. So the event I went to is webcast, meaning there's a video shown on the web in real time. And so you get the same access to information that all the big girls and big boys have at the other mutual funds, okay? You can also get past earnings releases and that sort of stuff. And of course, they give you financial information in Microsoft Excel format only. Okay, so here we are on Microsoft's website. Just search Microsoft and Investor Relations, okay? And we can click on earnings and financials and then financial statements. And then you can download an Excel spreadsheet, and many websites have this for you. Okay, you open it up and you download it, and you can import it into Excel, so you don't have to key in all the historical data. It's already done for you. Okay, and so that's the income statement. You get it from Microsoft and all the financials. Okay, second data source we've got is SEC.gov. We've talked about this before, but I want to talk about it again because it's so awesome. Okay, go to SEC.gov. Then you do a fast search. You put in the ticker, which is MSFT, Microsoft. Then you type in the annual report, which is 10K. Okay, so there's different types of reports. Remember I told you before? There's the 10K, which is the annual report. The 10Q is the quarterly report. And an 8K is a press release, right? So whenever there's something material or very important that happens to the company, they have to disclose it to all investors at the same time through the SEC.gov. That's called an 8K. And then there's an S1, which is the document that all companies have to file when they go public, which basically tells you everything you need to know about a company. It's awesome. Okay, so here's a 10K for Microsoft. And the cool thing is that you can get the past 15 or 20 years for Microsoft for annual reports. It's amazing. It's just a wealth of data. And this document is super long too, right? And so it tells you about the business of the company, the risk factors, legal proceedings, and all that stuff. There's a lot of stuff in it you'll never read, but it's there for you. You can do a search on the keyword income statement or select financial data and get everything you want to know about a company, right? And by law, they have to disclose everything that's important and every risk as well. It's an awesome resource, right? And so in this case, I search on the word revenue. And if you're using the Chrome browser, which is way better than any other browser, in my humble opinion, if you're using the Chrome browser and you type in the word revenue, for example, you see on the vertical scroll bar there, all those yellow instances. Those are all the instances of the word revenue, okay? And so it's a context-sensitive web-based environment. So you hit Control F and you search for revenue, okay? Or you can search for Nokia, which for some reason Microsoft bought. So Microsoft's a big company, growth is slowing, they have to buy growth, that's why they bought Nokia. And you can see that there are fewer mentions of Nokia in the annual report or the 10K, but you can see it there on the vertical scroll bar. Okay. So you want to keep it very simple. Remember, less is more. Don't overcomplicate stuff. So we start off with the basics, right? Like we're building a house, right? So one brick at a time, and we'll do that. And so like anything in finance or accounting or business, nothing is complicated if you start with the basics and build on it very slowly, okay? So we'll start off with the basics. So we start off with revenue, of course, right? And what we did was we just got this from their website directly. We didn't have to key in any of that stuff. All right, then we add layers, right? We're building our little Minecraft or Lego or brick-based house. I have kids that love Minecraft, which, by the way, Microsoft owns now. Okay, so now we add the cost of revenue, right? And that's given to us on Microsoft's website. And if you can't find it on Microsoft's website, you can always go to sec.gov and open up the 10K and just hard code that stuff in, okay? So modeling is very easy. It all comes down to one simple rule. I know you know what it is because I've mentioned it a million times before. What is it? That's right. Everything is just a percent of revenue. Everything is a percent of revenue. Figure out revenue and the rest of the model is a joke. It's easy, okay? All right, so yes, people make modeling unnecessarily complex. By the way, I don't know if you spell modeling with one L or two L's. You tell me. Okay, it's not hard. It's actually a lot of fun. Attitude is everything. Okay, once you see what percent of revenue every line item is, then you simply look for trends in the historical data, right? So remember to read financials like a good book. And then what you do after you find those trends is you make assumptions about the future, right? You're predicting the future, okay? Meaning what percentage of sales each line item is and why. And remember to add lots of comments. Okay, this is easy. Okay, let's get back to our Microsoft model now. So here's a little trick for you in Excel. You can name your revenue row. And the way you do it, or name any row, right, is you actually highlight the row. Okay, you see in row 8 there, I highlight it. And then what you do is you go up and you type the word sales. You'll see it in that little box up there, right? See the circle? Okay. And then what happens is from now on, you never have to say, divide a certain line by, row 6 or whatever it is. You just say divided by revenue and it remembers. Pretty cool. Big time saver. Okay, then we add the cost of goods sold, look at the percentage of revenue, gross margin is, look for trends over time, okay? And this is still historical data. Now we're putting in the operating expenses, right? You put it in for each year, you get it directly from Microsoft's website, right? So we haven't started forecasting yet, okay? And then you put in the rest of the income statement. Remember, everything below EBIT or EBITDA is called below the line items, right? Remember the Swiss companies that make watches that are inferior to our banana watch. I won't use that joke anymore. I'm sorry. So below the line items, you put in here, okay? And then you just copy and paste the percent of revenue column below almost every single row. Yeah. And you can see I put it in red here, okay? And I just made everything divided by sales, S-A-L-E-S, or revenue, same thing. And you can copy and paste, and it will remember which row is sales. It's awesome. Okay, great. Then you add the YOY percent change row. That should say ROW, okay? Or now, yeah, I'm not sure. So YOY means year over year change, okay? And so I put that in green. And remember, we're looking for trends, okay? You look at the year over year change, right? And then isn't cash flow and earnings different? No, they're the same thing in the long run, especially with tech companies, okay? And I'm trying to make this whole process easier. And the accounting purists will say, no, Chris, you're wrong because of this. I don't care, okay? I'm trying to make you see the forest from the trees. You might be off by 1% or 2% in the long run, but who cares? It's close enough for government work. So instead of being able to call a stock within, within 1% or so, use my methodology and you're off by a couple percent in the long run, but it doesn't matter when your target price is 50% above where it is right now, okay? Just stick with me. I'm going to teach you the basics, an easy way to do everything, okay? Because I've made a lot of mistakes in my career. Okay, great. What about the balance sheet, the cash flow statement, and the other confusing data they gave us? Who cares? That's right, who cares? Why? Because the income statement and the cash flow statement are the same thing in the long run. Okay, remember cash flow and net income are the same in the long run. You'll see in my model, I didn't include depreciation or non-tax items, okay? Less is more. Why do we not care? Again, because earnings and cash flow are the same in the long run. And you'll say, whoa, Chris, wait a second. You're wrong here, man. What about debt and the cash balance from the balance sheet? Well, okay, fine, you got me there. If they're huge, then we'll add them back or deduct them from our target valuation later, okay? There you go. Great. Okay. They're usually not that relevant though. Okay, not that relevant. Okay, wait a second here. Chris, if you're not including a lot of other stuff in your model, then won't your target price be completely wrong? No, might be off a couple percent, but who cares? It's only a couple percent. Okay, I'm trying to save you time. Let's get back to our model now. We are getting there. We're slowly building this brick house. Okay, we got everything now. We got all the historical stuff, and we can make our forecast now. Okay, and this is where it gets to be fun. Okay, so let's assume for this exercise we're at the beginning of 2015. Okay, I'm actually recording this in 2016, but let's assume we're at the beginning of 2015 for this exercise. Okay, so as you can see, take a look at that image there. And if you can't read it if you're using an iPad or something, then maybe open it up on a desktop with a bigger monitor. You'll see that all the stuff we're going to forecast has a little E beside it. 2015 E, 2016 E, 2017 E. What does E stand for? It stands for estimates. Okay, so let's do it. Okay. Wait a second, Chris. I want to add more detail on revenue to my model. I don't want to just have one line item. Come on, man. Microsoft has a lot more stuff than one revenue line item. Okay, fine. Microsoft gives us a lot more revenue line items. We can get it from their website. You got their consumer stuff. You got Xbox. You got their crappy Nokia. I did write that, yes. Their crappy Nokia stuff as well. I don't know why they bought that. Does anybody really use a Windows phone that doesn't work at Microsoft? Exactly. Okay, so we can add that too. And so here is that stuff. I've got all those line items, the revenue and the cost of goods sold for each of those line items. You can add that as well if you want to add more granularity or information in your model. But I'm not going to do that. I'm not going to do that because it'll take too much time for today's session. Okay, so before we make forecasts, we look for trends in the data, and this is where it gets to be a lot of fun, man. Okay, so again, learn to enjoy reading financials like a good book. Okay? Understand why revenue grows or contracted historically. Look for patterns. Understand financial history as well. So I'll lob one out for you here. Take a look. Why did revenue growth slow in 2001 and 2009? Because we had horrific recessions then. 9/11 occurred in 01. And then we had the financial crisis where we were within a bank, 24 hours, a bank machine's not working. Okay, fine. Next up, why did gross profit decline as a percent of revenue in 2001? Why? Right, I think that's 2001, yeah. Well, the reason is they released the first version of Xbox in 01 and 02. And Microsoft is a software company, hence the name Microsoft. But they made this hardware appliance, right? This big, ugly Generation 1 Xbox. And it's actually pretty cool. I got it and I loved Halo. But they lost billions of dollars on it, right? Billions of dollars. And hardware gross margins, or the cost of making hardware, is much higher. Hardware is not profitable at all, usually. So why did Microsoft do it? A little side talk here. So the reason Microsoft got into this market was because they were worried that Sony, with a PlayStation, would get in your living room and use your television screen as your computer monitor, therefore eliminating the need to buy a computer longer term. So for Microsoft, it was a hedge. And they did incredibly well in this market longer term, but they lost a lot of money. And this is why gross profits were down in 2001 and 2002.